This is our Forex blog for June 11th, 2012, and as we've gone over many times in the past, this is our new sortable currency meter, which links these charts, which are on a different layer, to a blank chart that, in this case, is set to link to the first currency in this quote sheet or hot list. And that way, you can sort it from strongest to weakest and weakest to strongest, and you will always be looking at the strongest individual currencies on the top, the yen, the dollar, the pound, the New Zealand, then the Australian, and the weakest ones are the euro and the Swiss. So in our easy three-step Forex trading system, step one is to use this currency meter and find the strongest currency, buy it versus the weakest, or if the strongest currency is on the bottom, you want to find the weakest currency and sell it versus the strongest one. So in other words, step one, you want to look for the strongest currencies to buy and the weakest currencies to sell. Then step two, wait. Traders are always too impatient, especially new traders. You need patience and discipline. You might have to wait 10 to 30 minutes, sometimes 45 minutes to an hour to find a high probability trade. You want to wait for a signal to show up. And then when you get a buy signal on the strongest currencies, you want to buy when it goes 1 pip over that signal bar's high. Or you can also wait for the trailing stop to get hit and flip down below price and then turn green and then buy. That gets rid of a lot of unnecessary losses. But like any forms of insurance, it has, a price. A lot of times you'll be buying 3 to 5 pips higher price, but you also might avoid 1 or 2 losing trades and get into a trade that works right away, and you paid 5 pips, for it. If you made 25 pips, you could have made 30 if you had bought it 5 pips earlier, but then again, you might have had a loss or two before that, which would have taken away 7 or 8 pips each time, so you might only be left with 14 or 15 pips versus 25. So you never know. Another part of step two is to sell the weakest currencies when a sell signal shows up, and when the price goes 1 pip below that bar's low. Or you can wait for the trailing stop to get hit and flip up above price and turn red, then sell. So for exits, inexperienced traders or traders with small accounts under 50,000 or 25,000 should use trailing stops for all of your exits. Professional traders and or those with larger accounts should exit half of their trade using these rules. If price stalls at the next support for sell trades or resistance for buy trades, exit half your position. Here are the key support resistance areas and areas that I find most important on top, and then as you read this, they get less and less important. So once you exit the first half, let's say at the Fibonacci profit target, you would use a trailing stop to exit at the other half. Now, keep in mind that if you draw your fibs to see the fib targets, markets rarely ever go beyond the 2.0 fib level. And hopefully we can find some examples of that today. And usually they don't go beyond the 1.618 fib area. So if it's 5, 10, 15 pips above the 1.618 and it's running out of steam, get out of the trade, because usually that's the most you're going to make, and a lot of times you can pick up another 8 or 10 pips versus letting the trailing stop get hit. Okay, step one with this, the yen and the dollar are the two strongest. The euro was weak pretty much throughout the day, as was the yen. So we're going to look at the chart for the euro dollar and euro yen first. All right, so we had a weak euro and a strong dollar and a strong yen. So here's the euro dollar chart, and it's above the hourly at this point, mainly because the market gapped up on Sunday. Big gap up. It's above the 3.0 green band. The weekly trend's up, the monthly trend's down. It really could go either way. But in real time, our currency meter was showing the dollar had incredible strength and the euro had a lot of weakness. So your choices are wait for the price to go 1 pip below the signal bar's low and then sell it. Or if you're a little bit more conservative trader, you can see in this instance you might have had a loss, and then a win. If you wait for the trailing stop to get hit, which is just slightly below price, you're in here with a small profit. You go short again here when the trailing stop flips. In this case, you're short around 2,600 and you got out at 73. I would have got out at the first support area right here. That's what I typically do. It's easier to trade when you start trading bigger accounts and more lot sizes. Let's say you sold 20 or 30 lots right here and you exit 10 or 15 right here with half your profit. Then you have a much smaller position on the second half. You can let it run. Sometimes you make more money on the second position, and other times it hits support area like this and then bounces up and you get back 10 pips. I don't like to get back more than 10 pips on my second half though, so typically, even if the trailing stop's 15 pips away, which most of the time it is not, you can see how tight our trailing stops are. You have another sell signal right here that if you waited for the trailing stop to get hit, you had a loss, whereas if you waited for the price to go 1 pip below the low here at 72, you pretty much broke even. And the lower containment bands are usually when price stalls. Once the market goes from the top band down to the bottom band, typically you're going to get a reversal. I don't like to sell right near the white band. I prefer to wait for a two-wave move, draw my fibs on the first wave, and wait for it to get somewhere between the first and second fib target. Support areas like the 20-day moving average, once they're broken, tend to become resistance. So there's a lot of resistance here. The fib targets off of this wave up. We have a weekly pivot level right here, and the previous day's high is right there. So it's a lot of areas where there's likely to be sell orders. So this is a very high probability trade. If you're waiting for the trailing stop to get hit here at 56, you got out of this trade right here at 45. Now 10 pips to a new trader doesn't sound like much, but 10 pips per day net will double your account every 2 months. So if you waited for a trailing stop right here, you got a loss. You got back in again here when the trailing stop got triggered right here at 52, and you're out at 32, 20 pip win. Let's take a look at the euro yen. Here's the euro yen. And again, earlier in the day when the euro becomes super weak and the yen becomes super strong, we're above the hourly moving average, so it's a lot less likely to trend down when it's above the hourly. And in fact, you have some counter trend buy signals right here near the hourly. When you get a sell signal, you can wait for the trailing stop to get hit. You can see here you have a loss, another 2 sell signals. The second trade right here in at 33, out at 25, small profit. You pretty much got back most of your loss. Another sell signal. It had already flipped. The trailing stop was already above price. So as soon as you get that sell signal, you can, in that instance, sell it here at 25, and it got you out down here at 92. So you have a nice almost 33 pip win right there. And the farther down the currency goes, the more likely I want a deeper pullback. You can see this went from 70 all the way up to 90, 92, 95. This is a much better, higher probability trade. We have a sell signal right here, and after a bigger pullback up, you can alternate between using the trailing stop to get you into the trade, and the farther the counter trend move goes up, the more likely it is to work. So you could just sell this right here, 1 pip underneath the low here at 88 versus 84, and catch another 4 pips. 4 pips here, 4 pips there adds up. 2 4-pip wins can get rid of one of your 6 to 10 pip losses pretty much. So always look at that as a possibility. So here you have a deep pullback, and if you shorted it right here with your stop right above the high, you would have had a loss in that case. If you waited for the trailing stop, you had a loss too, but it was much smaller. So here we have another pullback. Trailing stop gets hit at 83. You're out, and you get out here at 69. You have a nice tiny little loss here. Another counter trend sell signal. Anytime you get a sell signal within there's a bunch of up-down bars like this little rectangle pattern, that's a very high probability. I would be selling this right here at 84. And then, again, your trailing stop got you out here with the 20 pips on that trade. The only key to trading is small losses, big wins. So keep that in the back of your mind at all times. And you can vary your trade size. If you are afraid to take a trade but you want to, trade half your normal size or less. It might be a 30 pip win, but at least you're in the trade. If you find a really high probability trade, don't be afraid every once in a while to trade a little bit more lots. And so if you're right with the bigger lot trades and wrong with the tinier lot trades, that also helps to keep your average win much bigger than your average loss. And a lot of traders don't know this, but you can make money at 30-40% win rates. If you have $400 wins and $100 losses, you can be wrong a lot more than you are right and still make money. And so one way to get much bigger wins and losses is to wait for high probability trades like this one right here, much higher probability than this one. If you want to do, for example, let's say you have small count, you want to do 1 or 2 mini lots right here, 3 or 4 mini lots right here. You're short at 85, out here at 50, 35 pips. That's $140 with 4 mini lots. You know, whereas before, let's say you took a too many lot trade right here and you lost 8 pips, that's only $16. 140 pips, $16 worth of losses. And that's really, you know, what it comes down to. So let's look at the last one I plan on doing for class. Strong dollar, weak Swiss. So you want to buy the dollar Swiss. Okay, here's the dollar Swiss. And, you know, the dollar pairs gapped overnight on Sunday. On range bars, anytime you have a gap, wherever the price closes is where it just draws the bar for the whole thing. It looks better than having a gap. Anytime you see a big bar like that, you know there was a gap. And when it's underneath the lower containment band, usually it's going to reverse. But, you know, anything that gaps this much and is this weak, I would really wait for some signs of strength. Once you have some signs of strength with a currency, seeing the build your own trend, statistical trend go above 80, being very strong, very high percentage of dollar pairs are going up, Swiss pairs are going down. When you get a pullback with 1/2 or less, like in this case, there's 1/3 weakness compared to the previous strength, that's a trend that's very likely to go up. So you wait for the trailing stop to trigger right here at 28, and you're out of this trade here at 51. 21 pip profit, and if you got into this trade here at 30, keep in mind the trailing stops right here at 21. You're not only risking, you know, less than 10 pips. So this is 2 times bigger win than loss. And you have another buy signal right here, and at 56, out. Now again, anytime it's above the upper containment band, you might want to, with any sign of weakness here, get out of the trade. Also, drawing the fibs on the chart on the previous swing, you're near the 1.618. Remember, most of the time the market does not go above the 1.618, and a lot of times it stops somewhere between the first and second fib target here. So we had a counter trend sell signal here. You're better off just getting out of this trade somewhere at 82, 83, 85. In this case, you'd be in this trade at 50. Let's just round up to 60. You're out of this trade at 84. You made 24 pips. Again, risking 8 or 9 pips to make 20 to 25 pips. That's a very high probability trade. So you have a buy signal here and here. Wait for the trailing stop to get triggered, and you're out. It's a very small profit here. Another buy signals right here. You're in, small profit. And usually the market reverses at and above the white band. It rarely ever goes above the green band. When it gets above the green band, what I typically do myself is to kind of, when I see some stalling here, I'll get into a small position. If it goes up a little bit more, I'll scale in progressively. That yanks my average entry closer to where my last entry is. If I, for instance, sold one lot here at, let's say, 9 or 10, goes up to 20 right here, I do 2 lots. I have 3 lots short, somewhere around 16 right here, 4 or 5 pips underneath the high. If it pulls back, in this case, it pulled back 20 pips, I would make 14 pips on that trade, even though I got out really close to where my first entry is. And that's one of the things you can do when it gets above or below the 3.0 green band. Now, ideally, you get above there, and there's other resistance areas like the 10-day moving average. These are likely to be the maximum move. So you can scale into a trade, you know, getting bigger and bigger lots right near major resistance areas for sells.